We've got a lot of exciting news for you, good news, I promise. I know there's a lot of pessimism. We live in some pretty uncertain times right now. My job today is to cut through a lot of that noise. So I'm really excited to share with you our optimistic outlook for the future. Hopefully you feel better walking out of today than you do this morning opening the Wall Street Journal. Now, I come from a technical background. My father was the director of engineering at General Dynamics for 25 years. He's now the CEO of an aluminum strip casting company. You know, it's funny, when I initially went to college, I wanted to go for political science. And my father said, you know, the difference between a park bench and a political science degree is a park bench can support a family. So he said, go get a STEM degree. So I did. I got my degree in statistics and became an economist right out of college. I've been with ITR for the last 10 years as a public speaker. Really passionate about helping businesses navigate the economic cycle. That's my goal here today. So I wanted to kick things off first with just a couple of housekeeping items. Wanted to share with you our accuracy. I know that's important to everyone in the room. Also wanted to share with you how we think about the economic business cycle. I hope you can put our methodology into practice in your business. So I wanted to start there. Then we'll jump right into the global economy. Of course, I can't make it more than 5 minutes into a presentation without saying tariffs. So we'll jump right into looking at the global economy, discussing tariffs, how some of our trade relationships are changing, and most importantly, where's the growth going to happen as we navigate these next few years. From there, we'll jump right into inflation and interest rates. One of my favorite reality shows nowadays is the relationship between President Trump and Chairman Powell. It's a fun one, so we'll unpack that a little bit. We'll share our comments around inflation and interest rates for the next 5 years. From there, we'll jump into a couple comments around labor, a broader U.S. economic outlook. We'll look at the manufacturing markets, what vertical markets we expect to perform better than others. And then finally, we'll finish off with our speculation on the next time we'll see a recession coming our way. We want to make you prepared for the good times, the bad times. We're very optimistic on the next 5 years. We are expecting the U.S. economy to grow for 5 consecutive years. So it's a very positive outlook. We don't see the next recession coming our way until we move into the 2030s. So let's take advantage of all this growth over the next 5 years to better prepare ourselves for what's coming. So I'll jump right into things. I will have time for questions at the end, and the slide deck will be made available to all of you, but feel free to take pictures. Wanted to kick things off with our accuracy first. We start every presentation sharing our forecast accuracy. I'm not picking the series that we did the best in this year. We have to report on the same ones every year. But what I want you to notice from the chart, the major series we forecast down the left-hand column, that middle column is the number of months the forecast has been in place without being revised or changed to achieve the accuracy on the right-hand side. Now, these are billion, trillion dollar data series. You should expect a high level of accuracy from anyone that calls themselves a macroeconomic forecaster. Our competitive advantage is that middle column. That middle column shows you we can put these forecasts in place a year and a half ago and still achieve the high level of accuracy that you see down that right-hand side. I want you to be able to trust the information that I'm sharing with you today, not just next month or next quarter, but I want you to have confidence in that a year from now, 2 years from now. So that middle column is really our competitive advantage. Now, luckily for me, I get to take credit for our great team doing all this forecasting, but we've had a great year so far in 2025. Now, the other thing I wanted to share with you is how we think about the economic business cycle. We think about the business cycle in terms of 4 phases. They're clearly color-coded for you here on the chart, A, B, C, and D, and the way we determine which phase of the cycle we're in is based on where your growth rate is in relationship to 0. So when our growth rates are below 0 but getting less negative, which is where most of the U.S. economy is right now, that's what we call the recovery cycle. So we're not positive, but we're seeing things get less negative. You know, I met with a company last week and they just transitioned to the recovery phase of the cycle, and the sales team's all excited, and the CEO said, guys, that just means you suck less. And that's really what that phase of the cycle is about, right? It's about your growth rate seeing some momentum going. Now, when you cross above 0, you're in that green phase, that's accelerating growth, that's the best place to be. And this is where we expect our economy to be for most of 2026. So this is what we're preparing for now, is the growth that's coming our way. Once you cross over that peak, you move into the slowing growth phase of the cycle. This is the most important phase for any economist to identify for a client that they're working with, for an industry that they're working with. Because you're still growing, you're still feeling pretty good about yourself, but the growth rates are starting to slow down. So that gives us some caution. Because what often comes after slowing growth is a recession. Now again, the good news I have for all of you here today is the US economy is expected to only be in that green and yellow color for the next 5 years. We're not forecasting a recession until we move into 2030. So the next 5 years will be very exciting growth years for most of you here in this room. So let's jump into the fun. I wanted to kick things off with the global economy. I promise I'm going to keep the chart simple for you all today. I'm showing you 2 lines on the chart. They're growth rates. The dark blue line is the US industrial economy. The teal line is the global economy. Now you'll notice I talk about data in terms of industrial production rather than GDP. And you might be asking, why do you do that? Well, it's because all of you in this room are going to care a lot more about industrial output than you are about GDP. I can assure you of that because I correlate a lot of data on a daily basis, finding leading indicators, and all of our clients correlate a lot better with the industrial economy. When I say industrial production, 75% of it's manufacturing, the other 25% is mining, utilities, and oil and gas. So it's just a much more applicable data set. But there's a few takeaways I want you to have from this chart. First, if you look at that dark blue line in 2024, what not enough people talk about is the US economy was actually in an industrial recession for most all of 2024. That was not an easy time for businesses here in the US. A lot of the clients that we worked with saw declining year-over-year growth rates. Now, it wasn't as bad as some of the recessions you've seen in the past, but it still was a time where there was a lot of weakness. The important part is, look at that dark blue line today. We're starting to pull ourselves out of that downturn. The US economy is growing at a positive rate. The global economy there in teal is growing at an accelerating pace. So despite tariffs, despite uncertainty, we are seeing the economic data improve. And if you look at our forecast, which are those dots at the end of the solid lines, that shows that we expect growth for the next 12 consecutive quarters. Now, there's going to be time where the growth is accelerating versus slowing, but the key is those forecasts are not dropping below 0. So it's growth, it's just growth at a different pace. And that's what I hope the primary takeaway you all have today that you walk away with is we are preparing for 3 consecutive years of growth. It's a much different message than what you're seeing out there in the media. As you all know, I don't have to go into that. I'll leave the media alone today. But it's not a question for us, will we grow? It's a question, can you keep up with the growth over the next 3 years? Now, not every region of the world is growing at the same pace. There are some regions that are growing faster than others. I'm showing you the various countries and regions we forecast down the left-hand side. I really want you to point your attention to those 4 color-coded columns to the right. It's showing you that current 12-12 column, that is where the annual growth rate is as we're talking here today. And then you can see our expectations for the end of the year in 2026, the end of the year in 2027. You'll notice that a lot of those negative numbers disappear as we move into 26 and 27. Now again, acknowledge there's going to be certain regions that grow faster than others. There's also a clear impact when we looked at our data sets coming into the year as a result of tariffs. Any of Canadian folks in here today? Great. Thanks for coming. I know you're not big fans of us here in the U.S. right now, and for good reason. Our growth rate for Canada's economy coming into this year was about 1.5%. Now you can see it's only 0.9%. You can see how tariffs have taken the wind out of the sail of some of those growth rates. And you might be able to tell from my last name, my grandparents are Canadian immigrants into the U.S. They came in at some point in the 1940s. Don't tell President Trump, he might send me out. But it's a very challenging time in Canada because the primary reason for that is both exports from the U.S. to Canada are declining and imports from the U.S. to Canada are declining. It's taking a little bit of the wind out of the sail of the growth rates. You can see something similar with Mexico, right? You can see some of the negative numbers there. Now, again, I'm not going to go into each one of these countries. I know you all can read growth rates, But the key takeaway here is as we move into 2026 and into 2027, you can see this momentum building. So I don't want you to be looking at the data in this moment in time and not be preparing for the growth that's coming our way. Now, one thing our firm has talked about for a number of years is our concerns with China. We still have a lot of concerns with China moving forward, declining population, rising levels of debt, not that we're immune to that here in the US. But one of our main concerns with China is we're not seeing China's economy grow at the clip that they used to. If you look at the top lines, those are growth rates up top. The bottom line is the actual size of the Chinese economy. Notice the growth rates of the past 2 decades were double digits in China. Now we're seeing China's economy slow down to some of those single-digit growth rates. As we talk about the next decade and towards the end of my presentation in the 2030s, we grow very concerned with the Chinese economy. And part of that's our doing, right, with how the governments here in the US approach the Chinese economy. So as we've been thinking about supply chains, we've really urged our clients, North America is the place to be. And we'll talk about that more as we move along here. Now, I did want to give you some perspective on how we evaluate tariffs at ITR. When we think about, one thing that frustrates me as an economist is we talk about tariffs as all good or all bad. That's absolutely not the case. For some industries, tariffs might be okay. For other industries, they're going to be very problematic. I know it looks like a lot that's going on in this chart. It's simple, I promise. The industries are down the left-hand side here. Those 2 color-coded columns to the right, that domestically sourced column, that's showing you how much of that industry we produce right here in the US. And then that imported column is showing you how much we rely on imports from the rest of the world. So for those industries that have a high domestically sourced percentage, like petroleum and coal, I'm not that worried about tariffs being as disruptive for an industry like that. 91.1% of petroleum and coal is produced right here in the US. So I'm not staying up at night worrying about tariffs on the petroleum and coal industry. The opposite is true. Look at computer and electronics. We rely 85% on imports from the rest of the world. That's what keeps me up at night when I think about tariffs. It's the industries that we have a heavy reliance on imports for. Those are going to be the industries that are more impacted by tariffs. So you have to take an industry by industry approach to really understanding tariffs. Now, one other thing we look at as it relates to tariffs is the supply chain. And I know from walking around the floor, it's a pretty robust supply chain for a lot of you here. Wanting to talk about how we think about the supply chain, especially as a result of tariffs. There's 2 lines on the chart, again, they're simple. The dark blue line is the global supply chain pressure index. Anytime that dark blue line's above 0, the supply chain's under pressure, you're seeing longer lead times. Anytime that dark blue line's below 0, the supply chain's loosening back up. The light blue line is the Purchasing Managers Index, it's a manufacturing indicator, and it's a great leading indicator to where the supply chain is going. So I want to jump back in history. Look at 2018. That was the first time President Trump put tariffs in place. And what happened is that dark blue line rose above 0. We had a more disrupted supply chain as a result. So one of the challenges of tariffs, as many of you likely know, is the supply chain challenges. Now, as you can see from 2020 to 2022, we had the most disrupted supply chain in history. I'm sure that's not news to you all after the COVID fallout. But what I really wanted you to notice is the last few years that dark blue line's been at or below 0. We've seen the supply chain loosening back up over the last 2 years. Don't get used to that. Yes, I'm not saying we're not going to grow. We're very optimistic with growth, but there's going to be challenges that come along with the growth. And one of the challenges is you can already see the supply chain in our leading indicators starting to point above 0. It's likely going to be a slightly more challenging supply chain environment. And tariffs have an impact on that. Now, I'm not saying this is COVID all over again. Don't confuse that. But it's something that we have to be aware of. And so one thing that we've done as a result of this is we started to look at who has the most resilient supply chain around the world. I'm not telling you who the cheapest supply chain is. I'm telling you who the most resilient is. These are the top 10 most resilient supply chains around the world. I'm going to show you how we get to these scores in just a second. The US is broken down into 3 sections. So again, you can see the top 10 here. The way these scores are calculated is we take these 18 factors and we score every country on how they rank on these factors. And then we total up that score to get the top score. Now, this next chart is going, I know I showed you the top 10, but I want to show you some of the notable supply chains around the world. Look at who is more resilient. I know Southeast Asia gets a lot of attention for supply chains. I know China and India get a lot of attention for supply chains. But as far as I'm concerned, North America, Japan, Germany, these are the places that have the most resilient supply chains. So again, I'm not saying they're the cheapest places. That's absolutely not the case. But you can see at the bottom of the bars how these countries or regions rank globally. So this is one of the things that we say is, I think we learned a lesson from the pandemic. It's not always about who the cheapest is. Resiliency starts to matter. So keep that in mind for all of you supply chain folks, purchasing managers, as you're thinking about how to best position yourselves for the next 5 years. I know I'm biased being an American, but I see North America as our best bet. Last thing I wanted to talk about from a global perspective is how our trade relationships are changing. I'm showing you exports from our country to 4 other major countries, Canada, Mexico, China, Europe. I want you to just notice the end of the chart, 2025 moving forward, really since President Trump's tariffs have taken place. You can see the EU is really benefiting so far. The EU has been a lot more open to President Trump negotiating with him, and it is paying off as we're exporting more to the EU. China and Canada have seen a decline in exports from the US to their country. Mexico is about flat. So it gives you a little bit of an idea of how these trade relationships are changing. Now, that's exports, right? And while we're talking about exports, I also wanted to show you where is the US spending their dollars. So at least here's some good news still for Canada. You are still the #1 destination for US dollar investment. But it gives you a little bit of perspective of where is the US making their bets around the world. The EU in total is 82.8 billion. You can see that when you go back to that export chart, the EU is really benefiting from a lot of this US investment right now. But we also want to know who's investing in the US and how are imports into the US changing. It's a very similar story. So you look at Canada and China down below, see decline, right? This is what I was mentioning earlier around Canada's economy, is there's a decline in exports and decline in imports from the US. You can see that EU and Mexico have really been the beneficiaries so far. Now, one question we get a lot is, Taylor, we hear a lot about onshoring and reshoring. Do you expect that to continue? And the answer is yes. We haven't even seen the full impacts of onshoring and reshoring, and there's a lot more to come. These are the countries investing in the US. The US is the #1 country of foreign direct investment still. There are more countries investing in the US than anywhere else in the world. And that's another reason why we're very optimistic on the future of the US as we move forward over the second half of this decade. So again, you can see in total, the European Union down below 122 billion. That is #1, but on a country by country basis, Canada is still up there as #1. So even though we are seeing some challenges between the US and Canada right now, Canada's still #1 in investing in us, and we're still #1 in investing in them, which is why we still have Canada's economy growing in the future, just at a little bit of a slower pace. At the end of each one of these sections, I have a checklist. These are the things that our president and CEO at ITR hope that you take away from each one of the sections in my presentation. Again, for us, it's think about the supply chain. Think about how tariffs are impacting trade relationships. That's where a lot of our concern with China comes in, not to mention demographics, as we'll talk soon. The US is still the best bet forward. It's not to say we don't have challenges, but when we look at the underlying data, we are #1 in foreign direct investment. There's going to be more onshoring and reshoring over the next 5 years than anything you've seen in your lifetime up to this point. It's pretty great to be here in the US. Now, one of the other challenges from tariffs is inflation. That's not a secret to anyone in this room. I'm sure you've read all about that over the course of these last 12 months. But let me put into perspective first that, yes, we're seeing lower inflation and lower interest rates today. For us, that's temporary. We do expect to see some higher inflation as we move through the second half of this decade. Now, again, that doesn't mean we won't grow. That just means we have to be cognizant of the fact that this growth is likely to come at a higher cost. One of the primary challenges businesses have that we work with is, hey Taylor, our sales and our revenue are growing, but we're struggling from a profitability standpoint. Labor costs are really high. It's nice presenting this to all of you in this room because you're the solution for most of our country to this problem, right? We need to automate, we need to innovate, we need to find a way to drive down our costs. Otherwise, I worry about our profits over the next few years. And that's because we're expecting higher inflation starting next year. There are 4 reasons we talk about higher inflation. It is not just tariffs. Tariffs are the nationalism piece that's down below. We're expecting higher labor costs over the next 5 years. We're expecting the government to continue to spend. We're pretty good at that here in the US. And then finally, electricity and power costs, which you might say, that sounds oddly specific. It is. In 10 years of being an economist, I've never talked about electricity costs. I'll show you why here. I wanted to kick things off with our 2 inflation benchmarks, though, just to put things in perspective. So the chart on the left is consumer inflation. That's what the Fed looks at as they set interest rate policy. The chart on the right is producer inflation. That's your cost of doing business. Now, what you'll notice from both charts is we are in a period of slower and lower inflation. That is temporary as you look at our forecasts, whether it's the numbers down below or the dots that represent that forecast. So let's start with the chart on the left. Of course, as you know, the Fed lowered rates in September. I expect the Fed to cut rates 2 more times this year, 50 basis points lower. Take advantage of that because as inflation comes back in 2026, we believe the Fed's going to have to reverse course again. We do not expect interest rates to continue to come down into next year. Now, there's a caveat to that. Now, as an economist, I know better than to say anything with 100% confidence. But I can tell you with 100% confidence, Chairman Powell will not have a job next year. I think we can all be pretty confident in that. And does President Trump put a Fed chair in there that does what he's looking for out of interest rates, or does he put a Fed chair in office that follows inflation and responds to inflation? I don't know yet. That still remains to be seen. But with that type of inflation building in 2026, because of the factors I mentioned on the last chart, we think it would be very difficult for the Fed to lower interest rates. So our comment is, we expect interest rates to be lower for the next about 6 to 9 months. So take advantage of that. If you need to borrow money to invest in your business, if you need to lock in a long-term interest rate, if you're looking to buy a new home, think about making some of those purchases in the next 6, 9 to 12 months. Because we expect interest rates to gradually climb as we move into the next few years with this inflation remaining persistent. So we'll talk more about interest rates here in a moment. Now, the chart on the right that you're looking at is more important to all of you in the room because it highlights the cost of doing business. So what I'm saying is in 2025, it's going to cost on average 2.6% more to run your business than it did last year. And then in 2026, another 3.4%. On top of that, 2.6%, and then in 27, almost 2%. So this inflation forecast means our costs are going to continue to rise over the next 3 years. Now, again, that doesn't mean we won't grow, but that means we have to find a solution to driving productivity and efficiency in our business. Otherwise, our margins are going to be challenged over this period of growth. So, of course, I'll leave price increases and that to your all of your internal strategies. But for us, we need to automate, we need to innovate, we need to adopt technology because one of the primary drivers of this higher inflation is labor. I'll show you that in the next chart. Any way we can find ways to offset the labor challenge is going to be very important as we move forward. One of the reasons I say labor, for those of you that aren't aware, here in the United States, as well as Western Europe, as well as Japan, as well as China, we have these big baby boomer generations. I know there's quite a few baby boomers in the room. But the reality is we didn't have enough kids. I've got a 1-year-old, so my wife and I were working on it, but we didn't have enough kids. And so we've got the biggest generation that the world has ever seen retiring out of the workforce over the next 5 years. And if we don't have the people to replace them, it drives up our labor costs. So that's why we place so much emphasis on automation, on robotics, on innovation, because that has to be the answer. Otherwise, we're going to face labor costs that are rising very quickly over the next few years. And that's what I showed you here on this next chart.
I'm showing you on the bottom here, that's the average salary in the US. It's at about $68,000 right now. That's a record high here. But I want you to notice the growth rates up top. If you look at the growth rates, we're between 1 and 4% in the past 2 decades. But look at the last 5 years. We've gone as high as almost 10% at times in some of these wage costs. Our forecast for the next 5 years is that the cost of labor increases 28% in 2029. That's not a small number. That's the right appropriate reaction. Again, it's really multifactorial here, which is you've got the baby boomers leaving, we didn't have enough kids, we have a very strict immigration policy, which I'm going to leave the politics up to you all. It doesn't matter to me who you voted for, but that's a challenge from a labor standpoint. And so as a result, we're talking about 5, 6, 7% increase in the cost of labor each year. And that's why I say many of you in this room are uniquely positioned to help the U.S. out with this problem. Because we need to automate, we need to innovate, we need to find ways to offset this labor challenge. Now, one of the other challenges here is the cost of electricity, which again, I haven't talked about over the last 10 years, but look how out of hand this is getting. The dark blue line is our cost of electricity here in the U.S. The light blue line is one of the reasons for this cost of electricity rising, which is data center construction. Now, we love data centers, and what an amazing competitive advantage it is for our country. But there's a consequence of that, which is that dark blue line is showing you that our electricity costs are increasing almost exponentially. We have to find a solution to this as well. You have to think about alternative energy sources. You have to think about making your operations more efficient. I met with a manufacturer last week. His #1 input cost is electricity. It's that challenging. So maybe think twice about that electric vehicle too. That's going to be pretty expensive. It better be good for the earth or whatever you do yourself. But it's going to be a it's going to be quite a challenge moving forward. The last thing I wanted to mention is something that's almost out of our control. Our government's good at printing money here in the U.S. As a classical economist, it bothers me a lot because there's an unintended consequence to us printing money, which is inflation. The light blue line on this chart is inflation. The dark blue line is treasury issuances. The reason we issue treasuries is to fund our fiscal spending. Because our government's very good at spending money, the Fed has to issue more treasuries to keep up with their level of spending. What this shows you is anytime we pick up our level of printing money or issuing treasuries, it brings inflation. You can see, it's actually a 2-year lead time. So bear with me. What I've done is I've taken that inflation benchmark and I've pushed it back 2 years. And you can see the nice correlation you get. So when we printed all that money in 2020, you see that dark blue line moving up? 2 years later in 2022, we got a bunch of inflation. And then our government said, okay, we went too far, we're gonna pull back. That's why we have lower inflation today. But look at what they're back up to, right? It's pretty hard to ignore math on this chart. It highlights that there's more inflation coming our way. You know, I was mentioning earlier to a few folks, when Elon Musk came into the government in the first quarter and was cutting spending, I went to our bosses and I went, this is great, right? And our CEO just laughed at me. And he said, give him time. And of course, there comes the one big beautiful bill. Here comes all this spending and money printing, and we're back to doing what we do well, and that's spending a lot of money. And there's repercussions to that. So anyway, my whole intention of showing you this section is to say that there's higher inflation coming. We're still going to grow. Like I said, we've got 5 years of economic growth for North America. We're very excited, but we need to make sure we have solutions to some of the challenges that come along with this growth. And for that, that's some higher costs coming our way. Now, what this ultimately results in is, where do we see interest rates going? This is interest rates in the US and Canada, long-term interest rates. You're gonna see a box appear on the screen. That box is showing you, if you start at the right-hand side and work your way to the left, where we expect interest rates to go over the next 5 years. We're forecasting interest rates to finish 2029 at about 8% here in the US. Not a small number. Now, that's why I say take advantage of the next 12 months, because we do have interest rates coming in over the course of the next year. Now, when you hear interest rates of 8%, if you're a millennial in this room like myself, you're going, how do we grow? I said the same thing to our CEO, and he said, you need a history lesson, my friend. Look at the 70s and 80s. The economy grew at some of the fastest clips, and interest rates were 10, 12, 14, 16%. It doesn't mean we won't grow. But especially for all the baby boomers in the room, help us Gen Xers and millennials out, because we haven't lived through a period of higher interest rates before. You know, I bought my house in 2020, and they offered me a 3.1% mortgage rate. And I went back to our CEO, Brian, and I said, they offered me 3.1%. And he said, great job, pal. And I said, I think I can do better. And he said, you're an idiot. And he said, you know, lock in this rate and move on with your life. But again, it shows us millennials, we're used to 2 to 3% interest rates, right? Doesn't mean we won't grow. Now, that's the primary takeaway here is interest rates and inflation will be the lowest over the next year compared to what we expect for the rest of the decade. You need to have a plan for long-term inflation. That plan needs to include, yes, looking at prices, that's always the case, but more so it's the productivity and efficiency side. The businesses that can drive their efficiency and productivity over the next 5 years, those are the businesses that win the second half of the decade. It's that straightforward for us. We do have a free podcast where we cover the Fed on a weekly basis. So if you want to stay up with what we're saying on the Fed, watch this wonderful reality show we have, check that podcast out. We'll keep you updated. A couple of comments I wanted to have around labor. First of all, the labor market's a little bit loose today. If you need to do some hiring, think about doing that over the course of the next 6 to 9 months, because as the economy heats up in 2026, labor is going to get very tight again. Now, what this ratio is showing you is the number of unemployed people per job opening. So for every one job opening, we have about one employed person. And it's a pretty balanced labor market here in the U.S. It's slightly above 1, which is why they talk about a weaker labor market. But as we move into 26 and 27, as more baby boomers retire, or as our CEO calls it, the silver tsunami continues, we're going to see more tightness in the labor market. So if you need to hire in advance of this growth I'm talking about for the second half of the decade, really try to take advantage of the next 6 to 9 months. Now this chart is fun because it shows you what I'm talking about in terms of this labor shortage. I'm showing you participation rates of the different generations. Now the top 3 lines are 25 to 54. That's what they refer to as our prime age labor force. For those of you above 54, I think you're still prime, but that's how the economists identify it, right? Those aren't the problem. Those 25 to 54 are participating in the labor force as previous generations have. The problem is the 2 lines down below. The orange line's capturing the tail end of the baby boomer generation. The dark blue line's Gen Z. We can't figure out how to get Gen Z to join the workforce. It's a big challenge for us right now. And the bigger challenge is there's more baby boomers than there are Gen Z in the workforce, and that's what creates this problem. So, first of all, we need to figure out how to get Gen Z into the workforce. Now, everybody always says, Taylor, why is this? You know, there's 2 reasons. First, I blame on all their parents, so all of you in the room. Just a bigger emphasis on college. Their parents are the wealthiest generation to ever come through the country. I think there's some blame there. Now, the second thing, though, that's more serious is give Gen Z credit. They generate revenue for themselves in ways that aren't captured in job numbers better than any generation ever before. And that's social media, right? You know, when the TikTok ban came in, I thought, here they all come, but you know, that didn't last too long. The reality is we need to show Gen Z how they can transfer their skills to the workforce. Gen Z is the first generation that's starting to think this whole college idea is a little bit of a sham. We're seeing a decline in university rates, and we're seeing more and more Gen Z orient themselves towards trades. It's very early in the data for us to be confident it's a sustainable trend, but I actually have to give Gen Z a lot of credit. But again, we need to work with high schools, we need to work with middle schools, we need to work with colleges. We need to show Gen Z how they can transfer their skills into the workforce. It's very important. Now, the other challenge on this chart, you've heard me reference the 2030s a few times. We expect the next recession in the U.S. economy to begin in 2030. The primary driver of that recession in 2030 is the fact that we are going to have to take care of the baby boomer generation. And you will get expensive as you get older. And that's one of the challenges, right? Which is higher healthcare costs, higher Social Security costs. Again, we didn't have enough kids. And so we don't have enough people paying in taxes to support this big generation that will be retiring out of the workforce. So for you millennials in the room, I don't think I'm technically allowed to say this, but the best thing you can do for the economy is have 3 or more kids. That's really what we need at this point in time. Now, the last thing from a labor standpoint I wanted to share with you is where the growth is happening around the country. Now, it's always fun to look at where people are moving, but there's a real application to this. When you think about expansion opportunities, when you think about opening new locations, when you think about geographic areas you're looking to target, go where the people are. This is showing you population growth between 20 and 2024, so it's really over the last 4 years. This is my comment to say, who won the pandemic? Who attracted all the people as a result of the pandemic? People here from Texas at all? You won. Texas by far won the pandemic. Think about 7% population increase in Texas. Think how many people that is. Florida came in a close second. But again, you can see where people are migrating to. It's the Southeast, it's the Midwest, it's any place out west not named California, right? You can see some of that. I live in Texas, so I pick on California a lot. But the reality is there's really only 7 states that have seen population decline. You want to be in a green state. You know, that's really what you want here. You've got Mississippi, Louisiana, West Virginia. Those 3 states was lack of job opportunity was the #1 reason. Hawaii was too expensive. Illinois, New York, California was politics and taxes, and I'm not going to get into that one. But again, I want you to keep in mind these are percentages. Because I always get the question, Idaho, Taylor, what's going on in Idaho? It probably only takes a few thousand people to achieve that type of growth rate, right? So you need to keep in mind these are percentages. I presented this in Boise and they said, stop sharing this. We don't want any more people. But again, it's fun to look at where people are going, but one of the biggest variables in our economic models when we look at states of opportunity is population growth. It matters a great deal. So go where the people are going. When we think about the labor market, there's some slack in the labor market for the next 9 months. But as we get deeper into 26 in the second half of the decade, we expect more tightness in the labor market, higher labor costs. Yes, your turnover might be low today, but it's going to be a lot more challenging in 26 and 27. So again, I know we can't do this without people, but we need to find a way to bolster our retention, to make people more efficient through automation and our technology. That's really going to be the recipe for success moving forward. All right, let's talk about manufacturing in the U.S. economy. Wanted to first kick off this section with some good news. We track uncertainty in the economy. This dark blue line is the uncertainty index. The higher that dark blue line goes, the more uncertainty that we're facing. What many people don't realize is on Liberation Day, when President Trump announced all those tariffs, we saw uncertainty climb to a level that was higher than it was at the height of the pandemic. Put that in perspective. That's how much uncertainty we got at that time. Now, the good news is that uncertainty is starting to subside today. And this has major implications on the capital investment side of things. Because we were starting to see capital investment pick up into 2025, then this happens and it just stalls out. Now we're starting to see capital investment pick up. I've got all the data on that here shortly. And part of it is because the uncertainty is starting to come down. We're not back to normal. Uncertainty is still elevated. I'm not saying everything's all well and good, but we're starting to see it come in. And that's very important. Again, it has a lot of major implications on the investment side. So we've got uncertainty starting to come in. We have the U.S. banks lending more money than they ever have before, and that is good news in the near term. Talk maybe about how it makes me concerned in the long term. But this is good news. Banks would not be lending like this if they were worried about a recession. So when people ask, Taylor, how come you're not forecasting a recession? These are some of the charts I shared. Uncertainty's coming in. The banks are lending. Our financial conditions in the country are healthy. They're loosening. So this chart's interesting because usually we like positive numbers on charts, right? This chart is showing you that negative numbers are a good thing. Anytime that chart's negative, it means our financial conditions are loose. Anytime that chart's positive, it means we're tightening. That's when we have problems, like we did in 08, 09 in the pandemic. So we've got healthy financial conditions, and then our weekly economic index is growing at a healthy 2 to 3%. It's pretty hard as an economist to forecast a recession when uncertainty is improving, banks are lending, financial conditions are strong, and we're growing at a 2 to 3% weekly. So careful about the media perspective out there. We have a very strong economy here in the US, and that leads me to the GDP forecast for the United States. Folks, it doesn't get much better than this. With each new quarter of GDP data that comes out between now and the end of 2028, we're expecting a new record. That's the growth we should be preparing for right now. Now, again, there'll be times where that growth accelerates or slows down. You can see out there in that 27, 28 time, we get a slower period of growth. It's not a recession, it's just a slower period of growth. So this is what we need to be preparing for. Now, before I get into the manufacturing side of things, I wanted to highlight why we are so optimistic on GDP. 2/3 of US GDP is driven by all of us spending money. It's consumer spending. When we look at the consumer and how much money they're spending, the bottom line is showing you how much we're spending in terms of dollars. Over the last 12 months, our consumers here in the US in retail sales have spent $8.594 trillion. That's a record high. We're spending more money than we ever have before. That's important for our economy. But even more important is the top lines, which are the growth rates. We're spending above the rate of inflation. So inflation's at 2.7%. We're spending at 3.7 or 4%, depending if you're looking year over year or quarter over quarter. That's good news. That shows that our consumer's strong, our consumer's resilient, and that drives 2/3 of the US economy forward. Not only are we spending more, but we're making more money than we ever have before. I'm showing you two lines on this chart. The top line is personal income, including transfer receipts. The dark blue line is excluding. Now, this is another one of my favorite media headlines, is personal income's down compared to 2020. Well, you'll notice in that top teal line, there's this little rooster tail that you see. And so the media always says, compared to that time, we're down. Well, you know what we were doing during 2020? We were handing out free money to people. And so as a result, the media likes to spin this narrative of our consumers aren't making as much as they were before. But if you look at this long-term line of best fit that I put through, we're making more money than we have before, and we're rising above trend. So as much as I talk about the cost of labor being a problem for businesses, and it is, our consumers are making more money than ever before, and that allows our economy to continue to perform. That's why I show you the dark blue line down below, because it takes out the stimulus check impact, and it shows that we've just continued to make more and more money. So we're spending, we're making more money, and we're handling our debt just fine. I'm showing you debt on this chart. I look at debt as a percentage of earnings. Because another thing the media does is they just look at the absolute value of debt. And so they'll say credit card debt's at a record high, which is true. But if you look at debt as a percentage of the amount of money we make, we're handling that debt just fine. So if you look at household debt, it's 107.8% of earnings. And you might say, that sounds awful. That's actually below our 10-year average, and it's nowhere close to as bad as it was in 08-09. Same thing with credit card debt. Has it risen? Yes, but it's still below the pre-pandemic levels, and it's nowhere close to 2008, 2009. We're handling our debt just fine. So when we're spending more, we're making more, and we're handling our debt, again, it's pretty hard not to be optimistic on the path forward for US GDP. Now, let's talk about the manufacturing sector. So the dark blue line on the chart is the growth rate for industrial production. The primary driver of industrial production is manufacturing, and that's that light blue line that I pulled out. And so again, it shows you that, listen, manufacturing is cyclical here in the US. We all know that. We go through our periods of growth, our periods of decline. In 2024 for manufacturing and the industrial economy was a period of decline. But despite tariffs, despite the uncertainties, despite geopolitics around the world, you are seeing those two lines now above zero and rising. The reason I have a job is because we are able to see this growth coming in advance, and we can help businesses prepare so they're ready to take on that growth. And that is exactly where we are today. If you look at that forecast, we have accelerating growth in US manufacturing as we move over the next 5 quarters. And even as we move into 27, it's still growth, it's just growth at a slower pace. Again, this is 12 consecutive quarters of manufacturing expansion in the US. This is what we need to be preparing for. If you read too much into the uncertainty, if you read too much in the pessimism in the media, you're not going to be ready for the growth that comes our way as we move later into this year and into next year. Again, my concern is not will we grow, it's are you ready for the growth that's coming our way. The other important data set that's improved for us is CapEx is finally out of its downturn as well. The dark blue line on this chart is U.S. non-defense capital goods new orders. That's our fancy way of saying business investment or capital investment. The teal line there is our leading indicator. That's exports to the rest of the world. You can see anytime we're exporting more to the rest of the world, CapEx follows right along with it. It's pretty perfect correlation historically, right? Now, I want you to look at that dark blue line for just a moment. CapEx in the United States has been negative since September of 2023. From September of 2023 all the way till July of 2025, CapEx was negative in our country. We saw basically a 2-year recession in capital investment. But look at the data. It has now we're rising and we're above zero. We're up 1.4% today. This is why the uncertainty piece to the tariffs is so important. Because that dark blue line was getting better. I know it's difficult to see, it's hiding behind our leading indicator, but it was getting better. And then tariffs hit and that line just moved sideways instead of continuing its progress forward. But as this uncertainty has started to subside, as utilization rates are picking up, we're seeing more capital investment. So all I want you to take away from these last 2 slides is we expect manufacturing to be expanding for 12 quarters, and we expect capital investment to reach a new record high by the first quarter of next year. More people are going to be spending more money with all of their businesses than what you've seen over the last 2 years. Be ready for that. The last thing we want to do is turn away growth because we don't put ourselves in a position to be ready to take on this increase in demand. Now, certain vertical markets within manufacturing are doing better than others. That's no secret here. I'm showing you a lot of the different vertical markets we forecast down this left-hand side. Again, similar chart to what I shared earlier. That current 12-12 column, that's where the industry is as we're sitting here today. And then you can see expectations for 25, 26, and 27. So listen, I get it. If you're in the medical space, if you're in the heavy-duty truck space, you don't feel excited like I am here today. I get that. However, again, look at how those growth rates generally improve as we move into 26 and 27. The growth is coming. I know you've probably heard this from clients, from folks the last year. It's coming, but it's clear in our growth rates that we see most of manufacturing expanding. Now, the thing I love about these data sets too is their volume. I'm not showing you inflation. I'm not saying these industries are growing because of higher prices. I am just showing you volume increasing. There's a lot to be excited for. Maybe not our mineral mining friends, but it's a tough industry. It's a strict one here in the US. Most industries are prepared for growth. This next chart shows you more of these industries, and especially that US machinery new orders data set. Look at that, 3 consecutive years of growth, right? This is the optimism that we have. This is the growth that we need to be preparing. By the time we're in 2026, we will feel this growth across the board. Now, one thing I do want to highlight is it's clear where a lot of the growth is concentrated. I'm showing you legacy manufacturing in green. That's automotive. That's oil and gas. I'm showing you, again, there's more involved in that. There's legacy, what I call legacy manufacturing. The dark blue line is high-tech manufacturing, high-tech industries, semiconductors, our defense and aerospace, communications equipment, computers and electronics. Look at where a lot of that growth is coming. It's linear, right? Now, again, I'm not saying that green line is not going to grow. Because of onshoring and reshoring it will. You just saw the growth rates for some of those industries in the last chart. But I'm showing you where a lot of that growth is coming from, and it is the high-tech sector in the U.S. I'll give you an example. This next chart shows you the U.S. semiconductor industry there in light blue, and in dark blue you can see that high-tech manufacturing. It's driving a lot of that positive growth. It's one of the areas that we see growing faster than others right now. If you look at global semiconductor shipments, this industry is almost a $700 billion industry. The growth rates are growing at 20%. A lot of the work I'm doing right now for clients is finding these industries that are counter-cyclical to their business, industries that are growing at a faster pace. Semiconductors globally is one of them, and wait till I flip to this next slide. Look at those growth rates here for the U.S. 43.7% growth for our semiconductor industry. It's a massive industry here in the U.S. Another one we watch closely is data centers. Folks, we have 3 consecutive years of double-digit growth in data centers. This is a huge space here in the U.S. It's one that we're very excited about, and we expect it's the only data set that I'll show you today that has never had a recession. It has only been positive growth. That top growth rate has never fallen below 0. It's really interesting industry. Now, you know I'm very positive up until this point with manufacturing, with high-tech manufacturing, the U.S. economy. There is one area that I'll share with you that I'm concerned with. It's commercial construction. Commercial construction lags behind the economy. That's never been a surprise to us. So the weakness we went through in manufacturing in 2024, commercial construction is experiencing today. I'm not talking about the bottom falling out of commercial construction. We're just talking about a period of weakness like we experienced over the last 12 months. You can see that on this chart. Some of these commercial construction segments are negative. I'll share with you what's going on in commercial construction. The architects aren't busy. Anytime these values are below 50, it means that architects are seeing a decline in their buildings activity. Anytime these values are above 50, the architects are seeing growth. Most of these values are below 50. And that highlights that commercial construction is poised for a period of weakness. And we can see that here on this chart. The dark blue line, that's commercial construction. It has just entered a recession. You can see that dark blue line just fell below 0. The teal or the light blue line you see on the chart, that's our leading indicator. It's commercial occupancy rates. So commercial occupancy rates are down. Commercial construction is going through a period of weakness. Now again, this isn't the bottom falling out. I'm showing you 0809 for a reason. This is nowhere close to as bad as 0809. Just some mild single-digit decline before we pick back up in late in 2016 into 2017. So again, I always want to show you all the positives. I want to show you the risks as well. And my primary risk moving over the next 4 to 5 quarters is commercial construction. So very optimistic on manufacturing, a little less so on the commercial construction side. When we think about the U.S. path forward, folks, I guarantee you most of your data correlates with the industrial production manufacturing. I know it's been a tough last year, but you're probably starting to see green shoots in your business, and we expect those only to continue. It's time to prepare for growth. All right, last thing I wanted to share with you all is we always have to speculate, right? I wanted to talk about the 2030s. I know I'm saying this is the next time we expect an economic downturn. I don't want you to see this as a negative. We have 5 years of growth before we see the next recession in the U.S. Recessions are also the best time to grow your personal wealth and the best time to expand your business. We do not believe there's such thing as a bad business cycle, but it makes a difference on how we prepare for it. There are 5 reasons we expect a recession to characterize 2030. Demographics, we'll talk about that here in a moment. As I mentioned, we've got a big baby boomer generation around the world. Then we've got healthcare costs, Social Security costs are number 3, inflation, and national debt. Folks, we expect this to be a 6-year recession from 2030 to 2036. It's going to be a long one. But that's the best time to grow your wealth if you're prepared for it. 0809 and 1930, the Great Depression, both those periods, the financial crisis and the Great Depression, created more millionaires and billionaires in U.S. history than 2 moments otherwise. This is a huge opportunity, but let's be prepared for it so we can take advantage of it. That's the way I present this data to you all. Now, I wanted to kick something off with demographics first. Showing you population growth numbers. These come from the UN. So the solid lines where our population is today. The dotted lines are the projection for these populations in the future. Can you tell why we're concerned with China in the future? That one-child policy is really coming back upon them. China better get very good at AI and technology, because otherwise they're in big trouble as far as their population is concerned. Now I show you India. India is the best demographic trends in the world.
Not to say they don't have their own set of challenges, but you can see in the US, we're about shooting the middle here. We're not seeing massive population decline, but we're not seeing significant population growth as well. So we're not immune to this downturn of the 2030s, but we do expect to come out of this a lot better than places like China. Now, I also wanted to show you the rest of, I'd say North America, some of South America here too. Canada's population flat to slightly up. You can see Mexico's population. We love Mexico as economists. They have such a young, growing population that's going to characterize the next few years. That was the one thing I was a little grumpy about as it came to the tariffs on Mexico. They're a huge competitive advantage for us here in the US. Then you can see some of the other countries. This is why we say North America is your best bet forward. I call this the ugly dog contest, right? We're all in for some population challenges, but our trends are less ugly than what you get from the rest of the world, right? Especially look at Western Europe. Western Europe's in for population decline as well. Other than our friends in France and the UK, which import a lot of their young population through immigration, most of these countries are in for population decline. The reason this is so important to us is because what many people don't realize is when you have an older population, a bigger older population than the younger population, it is a huge financial drag on your country from a debt perspective. You don't have the same people paying in taxes. It results in higher bond yields. Your debt's more risky to buy. There's a lot of problems that come along with this. Folks, every 10 years we have a recession in the US. It has been that case all the way back to World War II. The question for us in the 2030s is not will there be a recession, it's how bad it will be. And we think this will be a tough one because we're going into these demographic challenges we've never experienced before. What many people don't realize is in the last 10 years of your life, you incur 90% of your healthcare costs here in the US. It's really expensive to die in the US. And when you have a big baby boomer population, that's going to be a big expense for the government moving forward. Now again, we're winning the ugly dog contest because at least we're not in population decline like most of these countries. I'm not saying the US isn't the place to be. I'm saying we're going to come out of this thing better than most places around the world. It just doesn't mean we're immune to it. Now, let me show you the opportunity that lies in this and why yes, I know we're talking about a recession, but why I talk about this as an opportunity. I'm showing you the different asset groups. The baby boomers currently hold $25 trillion worth of assets. Baby boomers, as a millennial, we have to thank you for giving us the greatest economy in the world. But the quicker you die, the quicker I get that money. And that is, something that's really exciting as we move into the 2030s. Now, but this is why I say it's an opportunity. Think of all the baby boomers that own businesses, that have personal wealth. For all of us coming up, I mean, boy, if you're ready for the 2030s, there's going to be businesses to buy, there's going to be property to buy. And for those of you that run businesses and plan on being in business during the 30s, think about the acquisition opportunities you're going to have, the opportunities you have to grow your market share. I'm telling you, recessions, depressions, downturns can be the best time to grow your business. So take advantage of the next 5 years to put yourself in a position to capitalize on this. Now, let me get back to a cause. I call this a dumbed down version of the US balance sheet. What this is showing you is we've got a debt problem and it's not going away. If you look at the red line, that's healthcare, Social Security transfer payments. We're spending about $4.7 trillion on those things right now. I'm going to come back to the blue line. The orange line, yellow line, that's consumption expenditures, schools, post offices, and things we need to make this country run. The green line, which is the one that I hate the most, is interest payments on the US debt. That's now above 1.1 trillion. We spend more paying interest on our debt than we do the entire Department of Defense budget, right? Put that in perspective. Here, the most frustrating statistic I'll share with you all today is it costs each one of you in this room $2,590 of your taxes every year to pay the interest on our government's debt, right? Think about that. We could all have another $2,500 in our pocket every year if it wasn't for our government spending this way. The reason this becomes a problem is because these accelerate as we move into the 30s with the demographic challenges we have. Now the light blue line, that's our income. So red, yellow, and green are costs. Light blue is our tax receipts. We don't make enough money to cover transfer payments, let alone everything else. And so I know a lot of folks in the room have said,
Taylor, we've heard this debt thing. Why is it a problem now? We've heard about it for 4 years. Well, because you just heard me say higher interest rates and inflation. That makes this more problematic as well. So this is something, everyone always says, okay, Taylor, what's the solution? Well, the solution is you need someone with the political will to raise taxes and cut spending at the same time. I'm not advocating for higher taxes. Please know that. But the reality is we don't have the political will to do what's right to avoid this. And that's why we're so confident in 2030. There's 5 questions you need to ask yourself as a business to prepare for this. How sensitive are you to interest rates and inflation? That's an easy exercise to do. Take your company's financial data and correlate it to interest rates and inflation. You need to know if you're going to see challenges with this higher inflation and interest rates. And I'm, of course, here to help you all out with that if I can. Are you in a market that's going to do well in 2030? That's the research we're doing now. We're sharing with our clients what geographies do you want to be in. We've talked about that a little bit today. What markets will perform better than others? There are 4 primary markets that we're most excited about: healthcare and medical, the defense industry, the energy markets, and technology. Those are the 4 primary markets that we're focusing on now, but we'll have a lot more information. Baby boomers in the room, I know you're looking to retire in the 30s, and you might say, well, this sucks. When we think about the stock market, I can't give you financial advice, that's not what I'm here to do. We're not afraid of the stock market over the next 4 to 5 years. We think the stock market's going to do very well. But be petrified of the stock market in 2030. Think of things, gold, think of silver, look at international bond markets. My comment is what grew your wealth up to this point is not going to be what grows your wealth in 2030. We're going to have to pivot. Make sure you make that pivot. By the way, there's 4 countries, bond markets, that we're excited about: Switzerland, Sweden, Canada, Australia. Those 4 bond markets do very well when the world's falling apart. Good place to put your money. But number 5 is the biggest thing here. I know I'm talking about this as a challenge, and it is. But there's a major opportunity again to grow your personal wealth, to grow your business. Especially if you're one of those businesses that takes the next 5 years to prepare themselves. You have a lot of cash, you have a low level of debt going into the 30s. You're going to be buying businesses, banks are going to be begging you to lend with them. Boy, it can be a real amazing time. Again, recessions, depressions, downturns create millionaires and billionaires. Be one of those people. There's a huge opportunity out there that's available to us. This recession lasts from 2030 to 2036 as far as we're concerned. Everyone says, why does it end in 2036? Because the baby boomers will all be dead by then. That is the reality. It's a tough sell. But that is just the reality of this demographic. Folks, I know I threw a lot at you today. Got a QR code here. Feel free to take out your phones and scan that. It brings you right to our website. We do a lot of free stuff. We do free blogs, free podcasts. I host a podcast every week. I'm not here to sell you anything, just here to give you some free resources to keep up with what we're saying. I want to thank Mazak for having me here. Last night was great. Today's been great. Really want to thank you all. I know 60 minutes of economics can always be a challenge, but I hope you had some positive takeaways, and I wish you all the best in 2026.